I want to use this time to talk about specifically the signs of the cash flow when we do the free cash flow calculation. So we know the formula of free cash flow is operating cash flow minus the change of operating working capital, and then minus the change on long-term assets. And further, this long-term asset is equal to the change on gross fixed assets plus the change on other assets. So the change on operating working capital is further equal to the change of the definition of operating working capital is current assets minus the non-interest bearing portion of current liabilities. And we said in class that this means we simply exclude short-term notes payable from the current liabilities. So if there are three major items of current liabilities: accounts payable, accrued expenses, and short-term notes payable, that means the non-interest bearing portion of current liabilities is the sum of accounts payable and accrued expenses. So that's the change on operating working capital. Hence, free cash flow, if we plug in this expression into the free cash flow formula, we have operating cash flow minus the change of current assets minus the non-interest bearing portion of current liabilities, and then further minus, if I plug in this change of the sum of these two, the change on gross fixed assets minus the change of the other long-term assets, mostly intangible assets such as goodwill or trademark. And further, let me write down here, operating cash flow equal to EBIT, right, earnings before interest and taxes, plus depreciation. And the reason we want to add back depreciation is because depreciation is not a true cash outflow, but in getting this EBIT, we deducted depreciation from the profit, from the gross profit, which from the cash flows perspective, which we shouldn't have done. So this step, adding back the depreciation, is simply to reverse what we shouldn't have done from the cash flows perspective. And then we minus taxes. So now let's plug in everything into this formula for free cash flow. So this is EBIT plus depreciation minus taxes. I can actually further write down, if this is if I assume the current assets is simply the sum of these three major items: cash, accounts receivable, and inventory. And sometimes I may have other current assets, so ACA. And this is simply, most time it's just the non-interest bearing portion of current liabilities is simply the sum of accounts payable, and then accrued expenses. So we don't have the short-term notes payable because that's interest bearing. We don't want that. So plugging everything here. So this is gonna be minus the change of cash plus accounts receivable plus inventory plus other current assets such as prepaid expense minus accounts payable minus accrued expenses. So that's basically this whole part. I just broken down that into this formula expression here, and then minus the change on gross fixed assets, and then minus the change on other assets. So then I can further write down this as EBIT plus depreciation minus taxes minus the change on cash. So basically I do the change on each of the items inside the parentheses. So minus the change on accounts receivable and minus the change on inventory and minus the change on other current assets. And then we have a negative sign here and we have a negative sign here. So negative becomes positive. Then we need to plus the change of accounts payable. Same is true for accrued expenses. The change on accrued expenses, we have a plus sign there. So finally, we have the change on gross fixed assets. We need to have a negative sign there. And we need to have a negative sign in front of the change on other assets, other long-term assets as well. So what I want to emphasize here is the sign in front of each of the item here. So the EBIT, that's positive. But depreciation, even though depreciation expense is an expense in an income statement, but here we have a positive sign before depreciation. And the reason is because, as we said, depreciation is not a true cash outflow, but in getting the EBIT, we deducted depreciation. So in getting back to the cash flow, we added back. So when we add it back, this is like a cash inflow, and that's why we have the positive sign there. So when you do your homework or during the exams, you also need to put a positive sign in front of the depreciation, not a negative expense, because the homework will ask you to give an appropriate sign to each cash flow. So for depreciation, you need to put a positive sign. And taxes, obviously that's negative, but the change on cash, we need to put a negative sign in front of that. And the same is true for accounts receivable and inventory and other current assets. But for accounts payable, we need to put a positive sign. And I think this is also quite intuitive. If you accumulate more accounts payable, so that means the firm has saved some cash upfront, because accounts payable means that even though it's a liability for the firm, but the firm doesn't have to pay right now. It can defer such payment until a later date. But cash flow here means it's current as of this period. So from that perspective, by accumulating more accounts payable, the firm actually, from the firm's perspective, it is like a cash inflow, and that's why we have the positive sign in front of it, the change accounts payable. And the same is true for accrued expenses. We have a positive sign here, but the change on gross fixed assets. So if the firm buys more property, more fixed property, like the building, the change on gross fixed assets will be positive, but the firm spend money in buying that building. So it's a negative cash flow or cash outflow. So we have a negative sign in front of it. And the same is true for other assets, other long-term assets. We also have a negative sign there. So now with that clear, I want to go to question number 4 of homework 1, and as an example to show you how we actually do this type of questions, give appropriate signs to each of the cash flow items. So this is question number 4, computing free cash flows and financing cash flows. And this is also a very good example of how to do the financing cash flow calculation, especially if we don't know dividend. Here, the dividend information actually is not directly given. So how can we get that information from the two statements, balance sheet and the income statement? So use the balance sheet, and that information we can click on this table and get the numbers, and income statement, that's also by clicking the button. For Pamplin Incorporation to compute the firm's free cash flows and financing cash flows, calculate the free cash flows using the following table. So pay particular attention to the instructions here. Round to the nearest dollar. So you don't have to keep 2 decimal or 1 decimal places. Here you just need to round to nearest dollar. Note, input cash inflows as positive values and cash outflows as negative values. And that's actually what we have done in this formula here. So first we get, in order to get the free cash flows, we start from operating cash flow, which is also after-tax cash flows from operations. So we know that we need to start from operating income. That's our EBIT. So let's check the information from the income statement. What's the operating income? Operating income is a 354 for 2002. 354. 354, and this needs to be a positive number, right? Operating income. Unless it's a loss, then we need to put a negative number there, but it's an income, so we have positive. And then the second item is depreciation expense. So again, that's from the income statement, depreciation. So depreciation expense is sort of a little bit not so easy to see, because this table has actually 4 columns, but I think they have the 4 columns is because this 250 here is actually the sum of the two numbers here. That's the total operating expense. So we just need to look at this column here. So the depreciation is 205. So 205. 205. Since this is a depreciation expense, do we need to put a negative sign in front of it? No, because going back to this formula, right? We have the depreciation, we have positive sign before it. And the reason, I think, is because in terms of cash flow calculation, depreciation actually becomes a inflow because we are adjusting what we shouldn't have done. So it's positive. And then finally, tax expense. And obviously that needs to be a negative number. So tax is 117. Okay, 117. So then don't forget about the negative sign. Alright, so after tax, cash flow from operations is simply the sum of these 3 here. So you can directly sum up the 3 because you already took care of the signs. So it's 354 plus 205 plus negative of 117. So once you do that calculation, you can find out the numbers to be 442. So that's my operating cash flow. And then we further do the change in net operating working capital, and then the change in net change in long-term assets. Here it didn't show yet. So we do the change in current assets. So what's the change on current assets? So let's use again, this needs to be from the balance sheet. So current assets is right here. So the change is last year is 1200 and this year is 1205. So the change obviously is 5. But the question here, do we need to put a positive or negative sign in front of it? Again, this needs to be a negative number, negative sign. Why? Going back to our formula here. So this is the change on current assets here. So let me use a red pen just to be clear. So this is the change on the current assets. You see we have a negative sign in front of it. And the change on non-interest-bearing current portion of current liabilities, we have a negative sign inside the parentheses, but we also have a negative sign outside it. So this two negative becomes positive. So we need to have a positive non-interest-bearing portion of current liabilities, and we already explained why we have positive previously. So we have a negative for the change in current assets, and we also need to get the change in non-interest-bearing portion of current liabilities. In this case, I think it's just the change in accounts payable, because that seems to be the only non-interest-bearing portion of current liabilities. We don't have accrued expenses, so that's the only thing. And here, the difference between this year and last year's number is 158 minus 200. That gives me negative 42. And negative 42, do we need to put the negative sign in front of it? No. Going back to this formula, we have negative and negative becomes positive, right? So we need to simply take the difference without adding the negative sign. So that's the negative 42. Negative 42. So decrease in net operating working capital is simply the sum of these two. Yeah, because we already took care of the sign. All here, we don't have to do the deduction. We just need to sum them up. So it gives me negative 47. So that's my change. And finally, we have the purchase of fixed assets. That's my change of the long-term assets. Again, that needs to come from the balance sheet. Long-term asset, we don't have an intangible asset. The only long-term asset here is the plant and equipment. That's the gross fixed assets. So we just need to take their difference. This year is 2,603. Last year is 2,200. So their difference becomes 403. And we need to put a negative sign in front of it, because this is the if we increase the gross fixed assets, that means we have purchased more gross assets, more fixed assets. Hence, we are paying money. That's a negative cash outflow, negative cash flow, or cash outflow. So free cash flow is simply the after-tax cash flows from operations plus the decrease in net operating working capital and plus the purchase of fixed assets here. And keep in mind here, we don't have to do the deductions like in the formulas because we already took care of the signs. So it's 442 minus 47 minus 43. That gives me negative 8. Negative 8. Alright, so that's the first part. I believe we can now check our answers to see whether so far we have done this correctly. So good job. Okay, continue, because we also need to get the financing cash flows. So we know that financing cash flows, we just need to get the financing cash flows to creditors and the financing cash flows to shareholders. So for creditors, we further have the further have the interest expense and the change in notes payable and the change in long-term debt. Right? We also need to put the appropriate signs in front of it. But we already did that part in our video lecturing on the free cash flows. We need to put a negative sign in front of the interest expense because by paying the interest, the firm has incurred a negative cash flow. But we need to put a positive sign in front of the change on notes payable and the change on the long-term debt. Because by increasing more notes payable, the firm or long-term debt, the firm receives money from the creditors. So going back to that question, first we have the interest expense, interest paid to lenders. Okay, so we find that information from the income statement. So interest expense of the most recent year is 61. 61, that's from the investor's perspective, from the creditor's perspective, but from the firm's perspective, this becomes an expense. So we need to put a negative sign in front of it. And then we need to take care of the change in notes payable, the increase in notes payable. So again, going back to the balance sheet now. Notes payable. Last year is 0. This year is 142. So their difference is 142. 142. Okay, finally we need to look at the long-term debt. Do we have any long-term debt? Yes, we do. Bonds. But look at the difference. The last year is 600. This year is also 600. So the difference is 0. I think that's why you don't have that item here. You don't have the increase or the change in long-term debt. And that's because the problem already looked at these two numbers and they know that the difference is 0. So we don't have to take care of that part. So we are done with the financing cash flow to creditors. And then we also we need to look at the financing cash flows to shareholders. So shareholders, similar to the creditors, they receive dividend. They can also exchange money with the firm if the firm issues more stock, the total common stock, right? Sometimes if the firm also have the preferred stock, we also need to take that into consideration here. So and we need to put a negative sign in front of the dividend because if the firm pays dividend, for the firm it's a negative cash flow. So first we take care of the dividend. I think that's the part which will require some thinking, because if you normally we can probably find the dividend information from the income statement. Sometimes that information is given. So now let's go back to the income statement to see whether we have that information. Unfortunately, we don't, right? The last item on the income statement is the net income. So we don't have, and we know that net income can further broken down into two parts. One is the dividend, another one is the addition to retained earnings. But here, unfortunately, we don't have that information. So how can we figure out the dividend? We can figure out this number based on this equation here. We know that net income equals, right? We just said that net income can be broken down into two parts. One is dividend. So one part of the net income can be paid to shareholders in the form of dividend, and the remaining part is retained inside the firm, and that's called addition to retained earnings. So in order to figure out this number, and this number is given, right? We found that number from the income statement, net income. In order to figure out this dividend, we can just try to figure out this addition to retained earnings. So how can we figure out this addition to retained earnings? Why don't we use the balance sheet, right? Because one of the items on the balance sheet, let's go back to that one of the items on the balance sheet is the retained earnings. But remember, every number on our balance sheet is a cumulative number. That's why we said the balance sheet is a snapshot, right? It's that number at that particular point in time, but it's cumulative over multiple years, multiple periods. So this number 803 at 2012 means that at that particular point in time, the firm has 803 retained earnings. But last year, it has 700 retained earnings. So the addition to the retained earnings of 2012 should be simply the difference between this 803 and 700. So that's how we can figure out the addition to retained earnings. Just take the difference. So going back to that, it's 803 minus 700. So that gives me 103. So that means the common stock dividends, we are not done yet. Sorry, this is simply the addition to retained earnings. So this is 103. Okay, this is 103. So what about net income? Let's go back to the income statement. So net income of 2012 is 176. So going back here, it's 176. Hence, 176 equals dividend plus 103. Hence, dividend equals 176 minus 103. And that gives me 73. So dividend is 73. So is that a positive or negative? Again, it should be a negative number because we are doing the financing cash flow calculation. It's looking at the cash flow from the firm's perspective. By paying dividend, shareholders receive money, but the firm has to pay that money. So it's a negative cash flow for the firm. So that gives me negative 73. And the next item, in order to get the financing cash flow to shareholders, is the increase in common stock. And here, since if you look at the one item right below it, we also have the choice of the repurchased common stock or treasury stock. So this increase in common stock is not the increase in total common stock, because the total common stock is the net issuance, net increase of common stock, which already take care of the takes care of the treasury stock. So here the increase in common stock should be understood as the difference between this year's number and last year's number. And based on this balance sheet, you can see the difference actually is 0. So increase in common stock is 0. And finally, we have the, as we said, we have the repurchased common stock. And that's the treasury stock. So the firm, if you look at the balance sheet, it doesn't have that information, seems to be the case. So we should assume that to be 0 too. Okay. So cash flow distributed to investors is simply the sum of all these numbers here. Again, we don't have to do any deductions here because we already took care of the signs. We just need to sum them up. And that gives us the final financing cash flow. And this gives me 8. So if you check, if you look at the cash flow, financing cash flows distributed to investors, this is 8. And the free cash flow is -8. And that suggests we have got the right number. That gives us much more confidence in this number, because we said the free cash flows should be the negative of the financing cash flow, and that's the case here. So now let's check our answer. Fantastic. Do we have another part? I think no. So we are done with this question.